Many people believe that private equity funds get better results than ETFs with lower volatility or risk. But is that actually true? In a new development, European brokers like Trade Republic and Scalable Capital and Deutsche Bank are inviting regular people to invest in private equity. In America too, the Trump administration has opened up private equity to regular people who are investing for retirement. Given my 18 years of investment experience, both on Wall Street and here in Europe, I am worried that beginning investors could make an expensive mistake by jumping into this market without understanding the true risks and benefits. So in this video, let's explore private equity and how it compares to classic ETF investing. And along the way, I will show you a few dirty tricks used by the private equity industry to fool investors, which honestly are just crazy. Okay, so first, what is private equity? Well, equity just means shares in a company. Private equity means investing in private companies that are not traded on a stock exchange, so these companies are not typically included in any ETF or index fund. If you invested 10,000 euros in your cousin's bakery, technically you would be a private equity investor. Conceptually, private equity investing makes a lot of sense. I mean, there are many more private companies in the world than public ones, and those private companies need financing. This is a clear opportunity for investors. But as a practical matter, investing in private companies is difficult for regular people. It is hard to research the company's financials and operations. Without data from a public stock exchange, it's challenging to calculate a fair price for the company's shares. Plus, you have to negotiate contracts and solve various legal and tax complications. So most private equity investors put their money into an investment fund run by professionals. There are different types of these private equity funds. Venture capital funds invest in startups and small businesses. Infrastructure funds invest in projects like wind or solar farms. But when most people say private equity fund, what they usually mean is a fund that does leveraged buyouts of established companies. This is kind of like what happens when you buy your dream house. You don't have enough money to pay cash up front, so instead you get a bank loan, which is then secured by the value of the house that you're buying. Similarly, in a leveraged buyout, private equity funds get a massive loan against the value of the company that they're buying. Now, they usually buy established companies which have plenty of assets and predictable cash flows, so the loan is usually big enough to cover 50 to 70% of the purchase price. After buying the company, the private equity fund will try to improve its operations and finances over the next few years and then sell it to a different investor. This is quite a great model for the fund because if the company succeeds, the fund earns a very high return against a relatively small amount of capital initially invested. But if the company fails, well, the fund doesn't have to repay the loan. Lenders can only recover money from the company itself. So the outcomes for the private equity fund are asymmetric. If you succeed, you win big time, but if you fail, you lose relatively little. Critics say that private equity funds are just a bunch of finance nerds with spreadsheets who often don't even understand the businesses that they are buying. Their only goal is to squeeze maximum short-term profits out of those companies so they can sell them to the next buyer a few years down the line. And they don't have to worry much about the long-term damage done to the company or their clients. This is what gives private equity a bad reputation with many people. For example, you'll find papers like this one, which shows that private equity-owned hospitals have worse health outcomes for patients. Or this one, showing that private equity buyouts are typically followed by job cuts and lower earnings for employees. And as we'll see in a moment, when you force companies to take out huge amounts of debt, a lot of those companies will get into financial trouble or even go bankrupt. And that's simply not great if you want your investments, your money, to make the world a better place. But let's put those moral considerations aside and ask if private equity actually makes good money for investors. When private equity first really took off back in the 80s, it was very profitable. In part, this was because there wasn't that much competition. You could buy private companies for relatively cheap. To use a technical term, maybe you only had to pay 5 to 8 times the company's EBITDA, which is a measure of pre-tax profits. And because you could buy companies for cheap with borrowed money, you could make a lot of money for your investors. But as usually happens, that success attracted a lot more competition and a lot more money to the private equity market. Today, there are tens of thousands of private equity funds competing globally. As of mid-year 2025, various estimates say that private equity has between $1 and $2.5 trillion in dry powder, uninvested cash, which is looking for opportunities. All of this money is trying to buy the same private companies. So to compete, these private equity funds have to offer those companies increasingly high purchase prices. And naturally, when you pay a higher price to buy a company, your expected profit level goes down, and you have to take on more debt to finance the purchase. So that means the risk goes up. What is even worse, interest rates have been going up in America and in Europe since 2022. And with much higher interest payments, many private equity-owned companies are struggling to simply stay afloat. The last few years have seen very high levels of bankruptcies among private equity portfolio companies. And according to one report from a group which is critical of private equity was behind 70% of large U.S. bankruptcies in the first quarter of 2025. At the same time, private equity exits, successful company sales, have slowed down considerably. For many years, the industry relied on one private equity fund selling its companies to the next private equity fund at ever higher prices. This has been kind of like a game of musical chairs. In many cases, these types of transactions have even happened under the umbrella of the same large private equity company. This created the illusion that companies were being sold at a high price successfully, while actually money was just being moved from one pocket to another. But right now, it seems like the music is stopping in this game, and many private equity funds are stuck without a place to sit. In fact, index provider MSCI recently wrote of the risk of the so-called zombie private equity, where funds have to keep holding on to their portfolio companies because nobody wants to buy them. Unsurprisingly, private equity investors are experiencing reduced profit distributions, and there have been news reports of major private equity investors such as both Harvard and Yale universities reducing the size of their private equity portfolios. So this kind of makes you think, doesn't it? If professional investors are concerned about private equity right now, could this be why there's this big push to offer private equity to regular small investors both in America and in Europe? After all, private investors are often more influenced by good marketing than by robust financial analysis. So maybe it's an easy way to offload some investments. Well, I don't want to exaggerate. Private equity can still be a profitable investment. But when the private equity industry markets their amazing historical profits and low risks, you should realize that today there is big trouble in this market, and the future is much less likely to look so amazing. Well, actually, it's a lot worse than that, because even those historical results are not nearly as good as many people think. The industry often claims that private equity has outperformed the stock market historically. Basically, they say that private equity investors have gotten much better results than ETF or index fund investors that invest in the public stock market. If that sounds too good to be true, that is because it really is too good to be true. First, unlike the public stock market, the private equity market is by definition private. Neither fund companies nor fund investors disclose full information about how much money they invested, how much money they earned in profits, and when. So the best we can do is piece together data from various industry sources. And naturally, the industry sources are often biased in favor of making private equity look more attractive. Second, it's very hard to calculate a profit figure for a private equity investment. Now, be patient with me here. I'm going to get a bit technical, but this is actually fascinating stuff. It made me really upset when I realized how this works. Okay, so the most popular figure used to calculate private equity profits is the IRR, the internal rate of return. You calculate this by taking all the cash flows of an investment, both the money you pay in and the money you get back out, and calculating a profit percentage per year, like maybe 10 or 15% per year on average. Now, importantly, the timing of the cash flows really affects the result. If you invest 10,000 euros today and you get 20,000 euros back in 1 year, that's going to be a much higher IRR than if you get your money back in 5 years. And that makes sense, right? I mean, the faster you earn a profit, the higher the average profit per year. But the problem is, this makes private equity IRRs extremely easy to manipulate. In fact, as far as I can tell, manipulating the IRR is pretty much industry standard. When you agree to invest in a private equity fund, that means you commit to give the fund money at any time over the next X years. As soon as the fund finds a company they want to buy, they will call for the money. So this means that until the money is called, you need to keep it in a safe place like money market funds or a bank account where it's always available. And because these places are so safe, you're not going to be making much profit on your money. Your money is just going to be sitting idle and not earning a profit for you. But the private equity industry doesn't take this into account when calculating the IRR on your investment. They're only going to start the clock ticking once they actually call the money to them. To use an extreme example, if you wait for 4 years with no profits, and then your money gets invested for 1 year, the IRR calculation assumes you've been investing for 1 year, not for 5 years in total. And what is worse, private equity funds will artificially inflate IRRs by waiting as long as possible to call your money. They will literally borrow money so that they can make investments without calling your cash, because this allows them to report a higher IRR. As a result, private equity funds get to advertise these amazing profit levels, like maybe 26% per year, even when their investors only earned maybe 10 or 12% per year when you take into account idle cash and all costs. And even that is not the full story. Because of the way IRR is calculated, it's heavily influenced by deals done long ago in the past. So if a private equity company had a few successful deals 20 or 30 years ago, today they can make one bad deal after another, but their long-term IRR will still look fantastic. So the second big problem is that private equity results are hard to calculate. And the most popular figure used, the IRR, is much higher than actual profits earned by investors. But the problems, they're not over. Now we get to the third problem, which is that private equity results need to be compared apples to apples, not apples to lawnmowers. Private equity promoters are very good at comparing their results to stock markets, which happen to be doing poorly at the time, even if it's not a good comparison looking at the fundamentals. For example, today, a common trick used by American private equity companies is to compare their results against the MSCI World Stock Index. This stock index has had a relatively modest performance over the past 15 years, and compared to this, private equity returns look pretty good. But the MSCI World Index invests in the stocks of developed countries all around the world. By contrast, US private equity companies mostly invest in US companies. If you go ahead and compare private equity results against US stock indexes, suddenly you discover private equity investors got very similar results to ETF and index investors. The extra profits basically disappear. That is why it's so important to find independent sources of information which don't have industry bias. In 2020, Professor Ludovic Filippo of Oxford University published a paper called An Inconvenient Fact: Private Equity Returns and the Billionaire Factory. Professor Filippo demonstrated that if you look at the best available public data of private equity returns and compare them with the most relevant stock benchmark in every case, you discover that private equity funds have returned about the same as public equity indices since at least 2006. In other words, after all costs are subtracted, after all the noise is removed from the data, private equity investors have gotten a similar result to ETF and index investors for at least the past 2 decades. And at the same time, private equity investors have suffered from disadvantages, such as lack of liquidity and transparency. Now, naturally, many in the private equity industry dispute Professor Filippo's findings, but I find them pretty plausible. And importantly, when Professor Filippo says that private equity is a billionaire factory, he's not talking about private equity investors becoming billionaires. He's talking about private equity managers, where the number of private equity multi-billionaires rose from 3 in 2005 to 22 in 2020. This is in large part because private equity funds charge their investors investors absolutely astronomical fees, which are pretty unrivaled by any other investment category. Even the so-called hedge funds, which are famous for their high fees, can't compete. The standard private equity fee structure is called 2 and 20. The fund manager earns 2% of your money per year plus 20% of profits, called the carry. Now, this alone is very high, but in fact, and this is something that many professional investors don't even realize, 2 and 20 is only part of the fee picture for private equity. Hidden inside many private equity funds are a lot more costs and expenses, which can add several percent per year to your true costs. For example, private equity funds often charge their portfolio companies consulting fees for helping improve their performance. Or private equity funds might place their own people in management roles where they get paid well above market compensation. Or private equity-owned companies might buy products and services at above market prices from other companies associated with the private equity fund owners. And then private equity funds will also often inflate the reported value of their portfolio companies because this allows them to charge their fees on a bigger total portfolio value, as highlighted in this recent report. In fact, according to Professor Filippo, when you properly calculate the total costs of private equity funds, the fee level reaches 6 to 7% per year. And to anybody with any kind of background in finance, that is just crazy. Compare that with 1 to 2% per year in actively managed mutual funds, or less than 0.1% per year for the best ETFs, and you will quickly realize that your money is being used to make somebody very, very rich, and that somebody is not you. Even though private equity results have been similar to ETF and index fund results historically, I would really ask, do you want to support an industry that burdens companies with huge loans, squeezes short-term profits, increases the risk of company bankruptcies, and charges you these huge fees along the way? And that is before you even worry about today's challenges in the market with high interest rates and rising bankruptcy rates. All right, but there is a second supposed benefit that private equity promoters love to talk about. They say that private equity offers smoother returns, more stability. So here's what happens. When you invest in ETFs or index funds, the value of your portfolio bounces up and down all the time as the market moves. Every minute of every business day, millions of investors are setting fair prices for stocks by competing in the market. And your portfolio instantly reflects those changes in fair prices. That means you can see very sharp rises and sharp drops. And this can be psychologically difficult because you're constantly worrying about what's happening in your portfolio. By contrast, when you invest in private equity, the value of your holdings does not get repriced every day. In fact, valuations are typically updated only once per quarter, and sometimes even less often. And when the valuations do change, the ups and downs appear much smaller than what you would see in the stock market. A lot of people see that and they think, wow, private equity must be a safer investment than stocks. But in reality, this is just an illusion. There's a reason academics call this effect volatility laundering. It's like sticking your head in the sand and pretending the risk doesn't exist. Not only do you get updated valuations of your investments less often, but keep in mind that these periodic valuations are produced by either the funds themselves or by third-party firms hired by the funds. And when you think about it, fund managers have every incentive to show you smoother, higher values. It keeps investors calm, and in some cases, it lets them charge their management fee on a higher reported value. The problem is, when you look at actual transaction data, for example, when investors need to get their money out, so they sell their private equity stakes in the secondary market, the reality starts to look very different. Prices there can drop just as sharply as for public stocks. If you ignore this, you can live with the illusion that your portfolio is highly profitable and stable until you actually try to sell out, and then you discover that your profits are much smaller, or possibly you're even sitting on a loss. In truth, the underlying risk of private equity holdings is similar to owning a leveraged portfolio of small cap stocks. And this is actually quite a high level of risk, more than most ETF or index fund investors might expect. The difference is simply that with private equity, you don't see this risk in your portfolio every day because prices don't get updated. And to make matters worse, unlike with stocks or ETFs or index funds, private equity investments are illiquid. You cannot just click sell and get your money back. Once you invest, your money is locked up, often for many years, and cash flow timing can be impossible to predict. Now, again, I don't want to paint too dark of a picture. Even with all these drawbacks, private equity has still managed to earn very respectable profits for investors. And allocating some part of your portfolio to private equity could have some diversification benefits, especially for advanced and wealthy investors. But don't believe the marketing hype, or you will be sorely disappointed. Private equity results are not that fantastic, and the risks are very real, especially today. If you're a beginning investor based here in Europe, I would prioritize transparent, low-cost investments like ETFs and index funds long before even thinking about private equity. Yes, ETFs and index funds also have their risks, but unlike private equity, ETFs and index funds have decades of transparent data proving excellent outcomes for investors, and you're not making anyone else rich with the ridiculous fees that you pay along the way. Now, with ETFs and index funds, you still need to know what you're doing. You need to understand how to choose a good ETF for your needs, how to select the brokerage that you can trust, and how to handle your taxes. But this is much easier than private equity investing. If you'd like to find out how to get started with ETF investing here in Europe, watch this video next, where I will explain it step by step.